All right, we got CPI. I got my coffee cup on the coffee maker. Hang on. All right. Wasabi! All right, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchangers. Foreign exchangers. Are you a foreign exchanger? Why not? We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Because trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne, good to see you. Whoa, such a weird angle. What if I did... Do we want higher? No, that's as high as it goes. Strange. Maybe that. I don't know. That's a little better, isn't it? Yeah, to each his own, right? So anyways, hey, what do you want to do today? How about CPI? Okay. We'll do CPI. That's good. Huh? Das gut, yeah. So we can do that. Anything else? No, probably not. If you're in my day trading group at investorbootcamp.com, we will be doing we're doing swing trading and day trading today. And in that session at 4 p.m., we are going to do something we call the Week on the Street, where we go and we actually download all the economic reports and read them together so that we are doing our homework, aka our job, together. And of course, you get my insight. So the markets are likely to move. Okay, markets are likely to move. My AI, technical analysis AI, has its eye on this chart here. Cool. Now this technology I'm going to launch has effectively been banned by about 200 brokers, maybe 300. Now, why would they do that? Well, it'll make you successful. Traders Way wouldn't care because they're an ECN, which means they don't trade against you, so they actually would like you to succeed as a trader. Traders Way would actually like you to succeed. This is why they value your education. Now, if you had artificial intelligence helping you put together proper technical trade plans, they wouldn't be negatively or adversely affected by your newfound skills. But most brokers would, and they would pass on such technology. They wouldn't want you to be successful. So anyways, it just points out Traders Way is different. They're good. It's a symbiotic relationship, and if you want a broker that benefits if you succeed, try tradersway.com. If you'd rather use a broker that benefits when you fail, go somewhere else. Cool. You're like, what technology are you talking about? I'm launching something very soon called traders.co. And if you're on the alert list, you will have the opportunity to help me shape the service. I need to know what you want, what you would like, what I need to know what you'd find helpful. I'd like even know the colors, the logo, the price. I haven't even decided on the price. So for everyone that signs up here, you'll be able to participate in the process of building this service around your needs. So please sign up. QuantBox is another AI service that I own, but it does quantitative analysis of economic data. Not technical analysis of charts. It does some trend analysis, but it doesn't do hardcore technical analysis. Like, it does this stuff. Okay? And, you're like, Wayne, that's easy, right? Yeah, okay. So it looks at that and does some calculations. Y equals mx plus b. Okay? M is equal to the rise over the run. Okay? And then you have to calculate the variance over the data points. And then you take the square root of the variance and you standardize it. So what's variance is like deviation. So now you standardize that deviation. And then you do linear projections based on the rise over the run. So you got to do this first, then this second, then this third, and then you can take the M, so M in the MX, and you do the rise over the run. And what happens is QuantBox then does base case, worst case, best case scenarios based on all that math. And you're like, dude, that's easy. I know, it's very, 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 very basic technical analysis, but on QuantBox, it's trying to tell you the long-term trend and then project 7 days in the future. Okay. The AI used over at Traders is very complicated and comprehensive. At QuantBox, it's just another point in the data set of, what should be versus what is. And Traders doesn't care about fundamentals at all. But we have a big fundamental day coming today. And Traders is interesting because it does do statistical analysis. It's not fundamental though. Now, fundamental, it would say things like today's CPI comes out 0.3. And it would say, ooh, QuantBox would say, ooh, put that into the data set. How does this make us feel about what the Fed's going to do? Traders doesn't think that way at all. It has a completely different brain. But machine learning is cool because it never forgets, and then it then sees patterns in the data. And so right now, I am looking at the back office. The front office isn't built yet. It should be done in the next couple of weeks. But I'm looking at the back office of traders.co, and it remembers the last 12 CPIs out of the United States. It's looking at all the major pairs, Aussie dollar, euro dollar, pound dollar, Kiwi dollar, dollar CAD, dollar Swissy, dollar yen. And it also remembers every single instance or iteration of CPI going back the last year. And then it breaks it down if the actual is less than consensus, or if the actual is greater than consensus, or if the actual is the same as consensus, which is 0.2. So it has all of this data. And then it goes back and looks at multiple time frames. What did each one of these things do in each actual situation of greater than, worse than, or as expected. Then it breaks down over the several hours, what do these pairs tend to do after CPI? Oh, okay, so if the actual is less than expected, it's not projecting the future, but it says for euro dollar up. It says Aussie dollar up. It says pound dollar up. It says Kiwi dollar up. It says USD CAD down, USD Swiss franc down, USD yen down. Now, in the situations where the actual is greater than 0.2, so in my example of 0.3, Aussie dollar down, euro dollar down, pound dollar down, Kiwi dollar down, USD Swiss franc up, USD yen up, so on and so forth. Now, I would assume that to be true because I understand fundamentally what I think would happen, and QuantBox would point to that. But like I said, traders.co doesn't think fundamentally, it only thinks technically, and it can tell you precisely what actually happened. Not what should happen, what you would think would happen, what you would assume would happen. It just knows that in the situation of greater than expected, 100% of the time, Aussie dollar fell. In 2 hours, in 4 hours, and in 48 hours. 100% of the time, euro dollar fell. 2 hours, 4 hours, 12 hours. But then by 12 hours, it's only 66.7% chance. What? Yeah. In fact, the interesting thing is 2 days later, it's usually up again. So it falls for a day and then it recovers. Well, hell's bells. Good to know. Well, maybe it only did that once. Maybe we don't usually have a situation where the inflation comes out higher than expected. And in fact, it is true. It only happened, it looks like one time in the last year. Cool. And I'm looking at it too, and it says 9 minutes and 46 seconds. There's a live timer. That's pretty sweet. Okay, so we don't know what's going to happen, do we? Okay, so now we wait. And we say, and again, this is technical analysis. By the way, does this blow you away that you would have all this information at your fingertips? Hang on, I got a notepad. I got notepad. Oh, I got it. How do I do this? Okay, let's see. Let me see if I can have it write a report for you. Would you like to see a little mini report? Hang on, it's not formatting properly. Maybe I clicked it by mistake. All right, let's see. Again, it's not predicting the future. Let me say it again. It's not predicting the future. Let me say it a third time. It's not predicting the future. If you're looking for a genie in a bottle, how do you say it? I don't know. I can't think of anything nice to say. If you're looking for a genie in a bottle, I have nothing nice to say. But this is past data. This is analysis of what has happened in the past. Past performance does not predict future results. Is it going to let me post it? Oh, it won't let me post it. Too many. Hang on, I got to make it in 2 posts. It's too much data. Interesting. All right, hang on. Hang on. Select all, delete. All right, so I got to break this in a couple of posts. It won't let me put it there. All right, did I kill my notepad? I hope not. All right, let's do this in 3 services. Copy, paste. Let's see. You ready? Are you still with me? No, still won't do it. You can get down to based. All right, I'm going to have to do a lot copying sentence by sentence, I suppose. Okay, hang on. This is a little mini report that it wrote. Almost done. Two more. Here's the actual. Okay. It was weird. It was like I heard a chewing sound. Must be my cufflinks or something. I thought I heard a chewing sound. How could I have a chewing sound? Can't have rats in the walls because all my walls are filled with soundproof foaming. Even the ceiling has all been spray foamed. Anyway, so here's the little mini report for CPI today. We can draw the following conclusions from the expected movement of euro-dollar based on the last 12 inflation rate month-over-month events in the United States. If the actual is less than expected, 75% chance that the 2-hour trend will be up for euro-dollar. If the actual is greater than consensus, 100% chance the 2-hour trend will be down. Now, it's not, again, not projecting the future. It doesn't know anything except the past. It's just telling you, based on what has happened over the last 12 months, that's what's happened. In the past, when it was greater than expected, it always fell. Based on what happened in the past, when it was less than expected, it almost always, not always, almost always went up. But how would you like to know that for every major event, news event? I think there were 11 events today, or this week. How'd you like to know that for every news event now, every major news event now? And in fact, know which ones are not major news events. But this is the kind of stuff your broker doesn't want you to know. This kind of stuff has been banned by brokers. Traders Way doesn't care. They're an ECN. They're like, shoot, dude, whatever. You do you, bro. They just execute the trade into the liquidity pool on your behalf. Yeah. Banned by brokers, baby. Was that 4 Bs? That's B4? Trade like never before. Banned by brokers, baby. Yeah, that's 4 Bs. All right, we're just, 2 minutes away? Oh, I have a timer. I forgot. Where's my timer? I have to click back. I'm in the report page. By the way, it actually shows euro dollar with the arrow going up 75% chance and an arrow down 100% chance based on that. But let's see. 55 seconds. Dang, there's a timer. Whoop, whoop. Okay. Yeah, well, historically I've been a VAR guy. It just means variable spread, but ECN means they can't or won't trade against you. Yes, it will. So we're building the calendar now, and it's actually I've known the CEO of the AI developer. I've known him for 20 years. And I went to him, I'm like, the calendar at Quant box sucks. Oops. Whoa, don't do that. Whoa. First response down. Was it greater than expected? For some reason, I can't move my platform. There we go. Sorry, I got bogged down trying to move my platform. Okay. Okay, greater than expected. So, greater than expected. And my AI said 100% chance of down. It was correct. Stock market is going to take a bloodbath today. Oh. Anybody impressed? Thank you, Jim. It's like Mikey, right? If Mikey likes it. Do you guys remember that commercial? What was it? Life cereal? Oh, well, if Mikey likes it, right? If Jim likes it, it's good. That's all that matters. Yeah. Yeah. It's got to pass the Jim test. Otherwise, it's bull crap. Yeah. Cool. Is that right, Sexy Crabber? Yeah. Cool, right? Yeah. All right. Just a ton of emails since I've been working this morning. It's only statistical analysis, Crabber. Does it put any weight on this time last year? It just looks at the last 12 and gives you the stats. It doesn't make, remember, it's really technical analysis. So like if you're saying, does it put any weight? Well, if you're changing weight, it's no longer technical analysis. You're adding some sort of fundamental bias to it. No, it doesn't do that. It's a completely different engine. So think of it this way. We have AI that does fundamental analysis, and we have AI that does technical analysis. It's left brain and right brain, and one can't do the other. Well, someone says recession. No. You're not doing it right. No. There's no recession, and that's the issue. It's the opposite of that, Osama. This isn't going down because it's bad. It's going down because it's good. Is that right, Dakar? Yeah, that's the big one, huh? Yeah. Okay. Now, this only reaffirms what QuantBox said 6 months ago and even 9 months ago. Can anybody confirm that statement? QuantBox has never had 6 cuts. QuantBox has never had 5 cuts. QuantBox has never had 4 cuts. And it does plot cuts, but not till the second half of the year. And it's always been that way. This is the rest of the market learning that QuantBox is right and they were wrong. Cool. Don is says, yeah, May cut is now off, which I've always, right? Like even in January when I did my Q1 outlook, I did not have May on the table. I did not have March on the table. I did not have January on the table. Right? January, March, and May were for me, based on quantitative analysis of macroeconomic data, 100% not going to happen. Okay? I don't know, Don. Depends on the situation and what they say. Okay? But remember, the idea of seasonal is it's always a force. It may not be precisely the same every year, but you don't just say, well, because the Fed's going to cut, we throw out seasonality. No, I wouldn't do it that way. Seasonality is seasonality. A farmer plants the seeds in the spring and harvests in the fall. That will never change. But every year the weather's slightly different. It rains early. It doesn't rain at all. Heavy snow in the winter. No snow in the winter. Okay? It's a wet year. It's a dry year. Okay? But there are basic rules that are always generally correct. Grumpy Cat said euro may bounce in a day or two. I only know statistically that is what has happened in the past. So like Grumpy Cat, I don't know, maybe. But the thing is, now you have the information. No, the problem, I suppose, is it only looks back over the last year. It drops older stuff because monetary policy has changed, for example. Well, the inflation, Richard, is really on the service side. Remember, rent is a service. Housing is a service. Your house or your landlord who owns your house provide a service of housing to you. Even if you own your own home, it's considered a service. Cool. Is everybody signed up for traders.co to be on the whisper list? I'm thinking, I don't know. I hate to say it because I've been going through from one development team to another development team and to another development team. And I'm so mad at everybody. I'm impatient and I hate waiting. Yeah. You know, and I don't like to be a grumpy cat when I'm a lover. I'm not a hater, I'm a lover, but these guys are making me grumpy cats. I want to go, let's go. They're like, it's difficult. I'm like, quit your whining. What's up, DP? Pegler? What are you doing? Don't you have an FX Street webinar or something? Anyways, yeah. All right, cool. Is that right? Good. Good. That means you have time to work with us. That's nice. Nobody, right? Nobody puts David Pegler in a corner. Yeah. All right, so anyways, bottomish, yeah. So remember, statistically, we know that in the past, when inflation was higher than expected, euro dollar dropped 100% of the time, but 48 hours later recovered. So when in the heck did that ever happen, you're probably saying? Well, I have to tell you when. Let's pop it back up. And so it was greater than expected. And what are we looking at? Euro dollar. So 48 hours later, 66.7% of the time it went up. And am I going to be able to pull up statistically when is the question? Let's just see if I can. Hang on, I'm still getting used to playing with the back office. All right, so anyways, dropping into a smaller time frame. I'm so glad we are able to go through this and say 100% of the time in the past for euro dollar, when CPI in the United States was greater than expected, this falls. Now, of course, that has always been my opinion. In that case, we're let me show you why it's happening. Let's do this. Let's just talk about why. Oops, I did the wrong one. Sorry, wrong site. Okay, so we go in here, and it's based on the May move here. And so let's just see. There's 64% chance. So two-thirds now the market believes there's no cut in May. Okay, so this is where we are. Yesterday it was 40%. So we've had a 50% increase in no cut in May since yesterday. 50% more people now, based on this news, say no cut. And what I've taught you over the years and years and years, and I love calling this the Johnny trade. Johnny said he's going to watch this every day, and when this shifts to the right, and so we went from 39, right, to this way, probability of shifted from here to here, and that's USD up. When you move to the right, it's dollar up. When you move to the left, okay, it's dollar down. And we had a 50% increase in right, dollar strong. Yeah. Someone who's like, yeah, and the whole world is in shock. Yeah, and once again, Quant has never deviated from that, even in the slightest. I mean, we can just go there now. So you got a Quant box. Let me log in. Go into the Pro. Wah, wah, wah. Okay. This is where I get my logic. Loading, loading, loading. Okay. Okay, now we're in the database. Cool. All right, so I go to the central bank tool. See, it takes a while to load because it's a database. It's not a website. Okay, there we go. We go into the dollar. So this is the Fed. Okay. Okay. So we have a cut. Further out. Okay. Now the interesting thing is where we're going to have, let's see, let's kind of look, zoom in here. Oh, I'm on the wrong one. I have to click this. This is the Fed's projection. Does anybody have the year over year? What's the year over year number? Oh, where is it? 3.1. And yeah, look at that. 3.1 is right where we're supposed to be, 3.12. This is the median, okay, median assumption through the dot plots. And then by the second quarter, okay, so April, May, June, it'll fall to 3.5. Sorry, 3.05, so 3.0, right? And in the third quarter, July, August, September, we'll break below the 3.0 barrier, aka wink, 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 the cut. Okay. Yeah. Cool, right? Anyways. Wow, huh? 100% chance of down. Good thing we knew. So let's zip over to the stock market because it's probably hedging day again. Hedging day. Oh God. So look what I have up here. I thought there could have been one more move. So last night in the day trading group, let me do this one in blue. We talked about this area here. And what I drew was down, up, down. And then what actually happened was down, up, down. Yeah. Now, in a situation like this, what I prefer is the double top before the drop. Okay, I don't believe in V-shaped reversals. So, you know, in some ways, I still want or expect to see something like that, huh? You know what I'm talking about? So, got to manage the pension appropriately. So like I said, the fund is right now 15% cash. which is a passive hedge, right? It's a passive hedge. And it's been planned that the stock market will come down. And it could come down for the next 6 weeks. Could come down longer than 6 weeks. The idea is, though, I have cash ready to deploy. Okay, I want to allocate, not today, but, you know, if we started doing this for the next couple of months, yeah, I would like to accumulate low. Okay. Now, the other way I can handle this is, okay, I have exposure to Dow, S&P 500, I'll just put SPX, and NASI. Okay, NASI. All right. What I could do is I can look at the beta here. This is beta plus. This is beta, and this is beta minus. It has the least amount of beta volatility. This is the beta, and then this has greater than the S&P 500. I could move out of NASI and go into Dow and hide there, meaning if the stock market drops, if NASDAQ drops 20%, S&P 500 might drop 15%, and Dow drops 10%. And I hide out there. This is called rotation. So I can rotate. Okay. Another thing I could do is I could take my best winners and cull the herd. Okay, I could take out the stag, the 6-point buck. I'll take him out. And then take out some of the old, the sick, and the weak. So let's say you take out, you cull some of your top 20% best performing trades, and you take out the bottom 20% of your worst performing trades, and you go to cash. And your portfolio, right, in this case, let's say, using this idea, the worst performing, you kill some of this. Your best performing, you kill some of that. So you're just profit taking. Your winners offset losers, for example, or best performing take out your least performing. They might all be profitable, but you get rid of that, and what you become is more concentrated in the balance. You could do it that way. So one, you could rotate out from high beta, low beta, or you can do a rebalancing, not a rotation, but a rebalancing, and then choose to go more neutral. S&P 500 being both value and growth stocks, you see? And the thing is, now that we're at this price, but also getting the technical analysis to agree with the fundamental analysis, you have to do something, don't you? Or are you just going to stop and stare? I brought down the photo. I haven't seen it in a while. I wonder if it's on the desk. You guys have seen the photo, right? Where I was pulling people out of a burning car seconds before it exploded. It was already on fire. And I was pulling people out of it. I found the photo and I brought it down to show. No, I don't see it anywhere. I haven't seen it. I don't know where I would have put it. Have you guys seen that photo? The car is totally on fire. And when the headlights exploded, it sounded like cannon to me. My heart stopped. Pulling people out. Now, the stand and stare thing, most people have it. They say fight or flight. I think people just do nothing. I don't know. Right? I don't know. I don't know what people do. But in that situation, I remember when we finally got them out of the car, which was incredibly difficult. Incredibly difficult. It was me and the truck driver. By the way, I love truck drivers. Love truck drivers. It's got to be some of the best human beings ever. You know, my wife and kids are sick with the flu, and so I had to find something to do by myself on Saturday night because I couldn't be around them, and I had nothing better to do. So I went down in my Casa de my Bubble Day Habano, and I had a cigar going, and I had my laptop, and I sat and I watched police body cam footage for hours, just watching. And every time there's like a shootout on the highway, you know, where the cops are like push the car over, and then they're going to have a shootout. You always see the truck drivers, they know what to do, and they block traffic and they stop it. Or they block the guy driving 140 miles an hour down the freeway outrunning the cops. Somehow the truck drivers always know what's going on, and they just block the lanes. And they're like, you're not passing me. Just like, okay. But going back to my story, I'm struggling to get these human beings out of a car that's already on fire. Like, there's flames inside the car. There's flames on the back side of the car. So I'm really worried about the gas tank exploding. And then it's so hot that the headlights exploded. Now, I'm between the fire and the headlights. Gives you an idea how hot it is, right? We pulled them through the window with great troubles. It was very difficult to get an unconscious person out the window. We couldn't open the door. The frame of the car was bent. So anyways, we drag them out of the way to avoid dying in an explosion. And I turn around and 30 people had been standing there watching us struggle. Watching us save people from burning alive in their car. They just stood there and watched. It was shocking and disturbing. 30 people. All over right? This was the 99. I think it was the 99. Way out in the Central Valley of California. And they're all just standing around just watching. It was really weird. It was and in zombie too. Like, not just like sitting there with popcorn and a soda going, wow, this is exciting. Frozen. Like zombies. Just frozen in shock, in terror, in awe, but certainly not helping. Yeah. So I don't know what people do, like, in this situation. Like, we're having a massive move here that's fundamentally and technically radically important. And most people will just do nothing or just do what they usually do. It's just another day, right? So I don't know. I guess training would be helpful. I know the training I had at NASA. So like I saved those 2 lives. I mean, there's no joke. I don't know if it saved their lives. But on 2 other occasions, something similar happened where my training at NASA to just push through the stress and just do what needs to get done has helped. And has led to, literally lives being saved. I'm not I've never been in active combat, and I know several of people in this chat have, and I suppose the training kicks in. So all we can do here, like with Investor Bootcamp, FX Bootcamp, the various other outlets, Forex.Today, this training is supposed to, since it's over and over and over and over again, over and over and over again, over and over and over again. Like I've known some of you guys for 20 years. You're here every day, over and over and over again. And what happens is the training and the regiment kicks in and saves you. Like Shackleton. So I've bought a bunch of books. I have an account of Ernest Shackleton's actual diary, which is kind of interesting. And what saved those men from death was training and regiment, and this is what we do over and over and over and over again. So I hope today you'll have today and tomorrow and the next day, you react appropriately to this situation. Okay? And I'm already, let's say, somewhat hedged in the sense that I have some 15% of the portfolios in cash. I'm somewhat hedged by having exposure in the Dow, exposure in the S&P 500, exposure in the bond market. So I own 20-year treasuries, stuff like this. Like I've kind of spread. Obviously, I have some NASDAQ. So I own basically every stock in the United States of corporations that have more than 1,000 people. I own them all, so I'm diversified. But then I'm balancing things where I do have less volatile mixed in with volatile, and now I can play with that. Plus, I'm in cash, and I can throw down a hedge. Now I can't hedge until the stock market's open, right? But now you have to react, and in this case, react appropriately. Stop traffic, right? Analyze the situation. Make sure the victim is safe. Get other people in the crowd around you to do things. You block traffic. You call 911. Okay? Step 1, step 2, step 3. Okay? Yes, you can use a futures contract. So like this triple X short is SPXS by direction, I believe. SPXS. Let's look at it. Okay. Okay, over the last month, it's lost money. Why? Stock market was going up. My spidey senses are telling me this is going to have a big day where it goes up in value. Why? Stock market's falling. See, it does the opposite. If the stock market's going up, it's losing money. It's $10 today. What do you think? Is it going to go up? Well, if I buy it. So if you want to be short the S&P 500 using leverage, you would buy this to get short. Okay? It's bearish, triple leverage. Okay? That's one way. That's an easy way. You just, boom, do it. Okay? Already 49.50. That was one of our lines in the sand. Remember? Let me drag it across. Yeah, very cool. You mean valuation of individual stocks, or you mean multiples, or what kind of valuation model? I mean, right? There's many. Right? So you have the one valuation model is the expected return of a stock is equal to the risk-free rate of return plus the beta, okay, of the expected return of the market minus the risk-free rate of return. Okay, there's a valuation model. You can also have the present value of a stock. So there's, right, what is a stock worth? So of a stock is equal to this year's let's say cash flow. So cash flow 24 over 1 plus I, okay, plus the cash flows or profits or whatever you want to measure of this company in next year over, okay, 1 plus I to 2 plus, we'll do 3 years cash flows. Cash flow, your expected cash flows for this company in 2026 is right, 1 plus I to the 3. So the question, what is I? So I this year, let's put it, let's say the Fed cuts only 2 times and it only goes to 5. So on average, it's 5.25, okay? And then by this year, the following year, it's 4.75. I know these are off, but let's just go with this idea. And then this is 3.75. Okay, so by 2026, the Fed funds rate is at 3.25. So you take this and then you have to project what is the cash flow or profits, if you will. So you can do profit of this company this year, next year, and the year after. What will the interest rates be this year, next year, and the year after? Discount it back. So that's when you hear analysts on TV talk about the discount rate. This is what they're talking about. And then you get the present value of the company right now, today, based on your valuation model. Okay? But you might be, Richard, talking about something different. But those are my favorite models, if you will. Okay? And the I over here could be the same as the RF up here. So RF, the risk-free rate of return, you could put the yield on the 10-year, but you could also have it, I mean, you could make that variable the Fed funds rate. But if the Fed funds rate is cut, which is the I, most likely yields on the 10-year will also drop. But so this is where you have to like explain your variables, but your risk-free rate could equal I. Yes. DCF, discounted cash flows, right? Over time. Yeah, and the other one is, yeah, the capital asset pricing model. Yeah. So the capital asset pricing model is saying, what is the opportunity cost of the investment? What is the cost of doing business? And what is the relationship between this particular company and the S&P 500? That's what the beta is. What's the relationship of the individual stock to the market? Okay, and then the expected return of the market minus your risk-free. So that's saying, okay, you have a choice. You can invest into the S&P 500, or you could buy, let's say, the 10-year T-note. Okay? All right. Don't you have to make a choice? How much money do you put into the stock market? And how much money do you put into the bond market? I know a 10-year T-note is not a bond, but just think of it. You're making a choice. And historically, even though recently it hasn't been accurately true, but historically, you would say, well, if you thought the S&P 500 would go up, you would buy that and sell bonds. But if you thought the S&P 500 was going to go down, you would sell the S&P 500 and buy bonds or treasuries, right? So typically historically they would have an inverse relationship. Now we know since the Fed has come in and added things like quantitative easing and quantitative tightening, they've destroyed that relationship. But what this is trying to represent is you are making a choice. And that's why the ERM minus RF is actually an opportunity cost. For example, if you thought the stock market was going to go up 10% this year, but you give up 4% on a 10-year T-note, it would have just paid you the 4%. But you gave up 4% to buy the S&P 500 with your expectations of 10%. So in reality, your expected return relative to the base, if you will, the broad stock market versus the broad bond market, okay, you are, right? There's an expectation of 6%. So this means now it's an opportunity cost. So you could do that and get 6. But what if you can get a real estate investment? So you buy an apartment building with a cap rate of 7. Well, depending on your analysis of risk, that might be a better choice. But if you felt, for whatever reason, risk was higher on that, your risk-adjusted performance or risk-adjusted analysis would say, no, I'm better over here on this 6. Okay? Okay? Does anybody know what you would do here to analyze this versus this, to do a risk-adjusted performance analysis? Type in your guess or type in a question mark if you just have no idea. How could we compare investing into stocks, bonds, or real estate and compare apples to apples, not apples, kiwis, and bananas? How do you standardize the analysis? No. These are, if you invest into the real estate because of a 7% cap rate, you're expecting that cap rate to stay the same. You're expecting the S&P 500 to go up, and you're giving up some 10-year T-notes. So this has all your expected returns. How do you compare them? Standard deviation of the expected returns. Yes, there's a way to do that. You wouldn't. So one way you could, and I think you're getting there, Richard, is where you could go, okay, scenario 1, S&P 500 goes up 15%. Scenario 2, it goes up 10%. Scenario 3, it goes 8%. And then you do a deviation based on volatility. No, there's an easier way of doing it. Plus, you're not going to be able to analyze these two versus, let's say, a third opportunity, which could be investing into a Forex trader. Well, their returns could be completely different than these two others, right? So what you're trying to do is risk adjusted. So when you can't make a decision on absolute returns and you're trying to analyze risk, you do the internal rate of return per dollar allocated. What kind of return? And you want the higher IRR first, and then you roll over to the absolute return. So this might be a 6%, this might be a 7%, and let's say the Forex trader, FX trader, is 20%. Okay, but the internal rate of return could be very significantly lower here, be okay here, and you might find when you look at the amount of risk you're taking here, the internal rate of return could be higher. Well, you wouldn't only look at net present value, because that wouldn't work in real estate. So that would be, okay, maybe incorporated into your cap rate, but you want to also look at the asset's ability to appreciate over time. But there may be no appreciable appreciation, right, in 1 year. Okay. Well, you want to start with the internal rate of return to compare, to standardize the risk-adjusted performance. Otherwise, you got bananas, coconuts, and apples. Which one's a better deal? So think of it more of a valuation of your dollar. So if you put in $1 and this one gives you $1.50, this one gives you $1.60, and this one gives you $1.80, okay, then you're no longer comparing 20% versus 7 versus 6. And all of a sudden, the one with 6 per dollar is giving you this. Then you'd want to go back to your absolute return and say, well, you definitely don't want to do the Forex person. Even though they're doing a 20% return, they're not compensating you for the risk. So they give you 20% this year, and then next year they give you negative 20. And you're like, pass. You just can't statistically analyze it. There's just too much volatility. So then you go, now you're comparing 7% versus 6%. And you find out the 6% gives you a better internal rate of return, but that one will make you $1 million. This one will make you $2 million. So you're like, okay, I'll take the lower IRR, but 1.6 is still acceptable. It's not as good as 1.8, but you'll make twice as much money. So you're like, okay, well, I want to make twice as much money. So you go through all this analysis, and then you say, all right, we're doing the real estate deal. And all of that is in these valuation models. So this is me answering your question. Do I use valuation models? No. No, I do. Yeah. But you might be saying, okay, you want to buy Apple and it's only 700 times earnings. Okay. Which is earnings. So you're like, okay, so you got your, let's say, what did I call it before? Cash flow of 2024 over 1 plus I to the 1, because it's this year, so, or 0 or whatever, to the 1. So if you said, okay, based on how much money Apple has made this year or expected to make this year, and you calculate that out, and that, so over 1 year, that's the expected return of this. And then you find out the numbers don't add up. So it's actually this number times 700, which means it has to keep making that amount of money for the next 700 years. Well, okay. You're like, well, that's ridiculous when nobody does, 700 times earnings. Okay. Well, 30 years, you're paying for 30 years of this cash flow up front? Because very often you'll find companies in the S&P 500 that are 30 times earnings. And that would be a valuation ratio, okay? Then you're like, but that doesn't make any sense. Well, that's people buying high and expecting it to go higher, but they're not doing a cash flow analysis. They're trying to buy good real estate that will, right? How do you buy good real estate? The best apartment building in the best location, in the best neighborhood. You pay more money than everybody else. So you might say, well, 30 times earnings is ridiculous. Yeah, well, Apple prints money. Maybe. Tesla prints money. Maybe. How is Apple going to grow 10% a year for the next 10 years? Which, when you're doing compounding, it's not 100%. That's almost 200%. So in the next 10 years, how will Apple get 200% more people owning iPhones? Okay? That would be like going from 100 million customers, okay? So 100% would be 200. And depending on how you do your math, it could be let's say 300, but you could also make it 400. So let's just split it. How is Apple going to go from 100 million to 350 million customers in 10 years? Well, that's what you're paying for now. Can they do it? I don't know. Okay. I liked the company when it was $6 a share. That's when I bought my shares in Apple. Yeah. Okay, the stock market's about to open. Daddy's got to go to work. Papa's got to go. Okay. So anyways, valuation model, sometimes it matters. At some point, though, it is like real estate. So let's say there's 500 companies you can own. Let's just say it's the S&P 500. There's not actually 500 companies, but whatever. Let's say you can pick and choose 500 companies. There's two ways of doing it. Find a company that's undervalued. They're making money, they're making profit, their customers are happy, they own a little mini monopoly, but for some reason nobody's paying attention. So you buy it for cheap based on your valuation model. So you look at their cash flows and all that, and then you analyze what you expect the cash flows to be in 3, 4, 5 years. So I showed you how to do the discounted cash flow model, and you say, okay, they have a mini monopoly. They're so good, this company, and the customer service is great. So the customers are happy and they want to buy more. So you're like, for the next 5 years, they're going to have a 10% increase in cash flows year after year after year. Okay, great. So you model all that out. You come out with the price and you find out it's undervalued right now based on your assumptions. So you buy it. Very few people do that now. That's too much work. Don't ever forget, even experts are stupid and lazy. You cannot rely on anybody. I don't care if the person is making $500,000 a year working at a multi-billion-dollar fund Don't ever listen to anybody, especially some idiot on YouTube. Don't ever take advice from a YouTube guru. So listen to me. You're going to have to make your own decisions. And you probably can uncover deals like that. But that's not how the world works anymore. So the biggest funds are probably the dumbest funds. And what they want to do is they want to buy Apple because they think Apple shares are going to go up. Why? Other people are buying it because they think it's going to go up. Why? Everybody wants to own Apple. Why? They cover it on TV all the time. Mutual funds buy it all the time. It's in the index, so the index people have to buy it all the time. It's just the thing moving. It's the best building, right? It's the best building in the best city, in the best neighborhood, with the highest rents. It's most desirable. It's walking distance to everything. Everybody wants to live in this apartment building, and that's it. Doesn't make it good, doesn't make it right. You're like, but the valuation is crazy. It's 40 times earnings. Yeah, well, it's going up because people are buying it. But when it comes down, what do they say? You take the elevator to the roof? And how does the stock market come down? Well, it jumps. Elevator up, gravity down. So be very, 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 very careful. Today, don't stand and stare at the burning car. Because your money is inside the car, honey. Go protect your money. Do what you've been trained to do. Change the world. Save your world. Take care of yourself. Take care of your family. And then give back. Peace on earth. May the pips be with you. May your profits be above average. I'll see you later today for the week on the street over at investorbootcamp.com. Richard says that's why we have to find the low risk investments and get. But what I'm even saying is even then it doesn't work anymore, because if you buy the low valued, you said low risk. It's not really risk, but if you say I'm going to buy those good companies with little mini monopolies that are undervalued that nobody's looking at. The issue is nobody's looking at it. So if you buy it and you're like, this is a great company and I got it for cheap, it's not going to go up in value. Let's say investing in the Magnificent Seven at this point is dumb. It doesn't matter. They're still likely to go up. And your smart investment is not likely to go up because nobody wants to own it. That's the thing. You have a really nice apartment. It's got a great cap rate. Well, it's in Toledo, Ohio, but it's profitable. It's not in Miami. It's in Toledo. Well, it's profitable. It's in good shape. You got good renters. But when you go to sell it, nobody wants to buy it from you. So you just got to sit on it forever. So I hope they pay a dividend. I hope they do stock buybacks. That kind of thing. Yeah. So peace on earth, may the pips be with you, may your profits be above average. Cheers.